Hi everybody, and welcome back to FANG Friday. This is Ross Healy, the Chairman of Strategic Analysis Corporation and a Senior Portfolio Manager at McNichol & Associates Asset Management. Two things today. First, as always, remember to like this video, and if you haven't done so already, you can subscribe to our YouTube channel to make sure that you get these videos every Friday as we publish them. And again, a special thank you to everyone who liked this last week. It really helps with the YouTube algorithm. Second, last week I promised you that I would lay out for you a roadmap of how Apple could double its market cap to $4 trillion, and that it looks like it's planning to do just that. So today we'll go for a ride on the Roman Candle Express, and I will show you the bull case for the stock, as only SVA is able to do. Finally, just a reminder, if you have been watching FANG Friday with us for a while now and want to take that next step, send us an email outlining where you are on your investment journey. Anyway, with that in mind, let's take a look at the FANGs. Before we do, however, I want you to pay special attention to something, and that is to say the slope of the breakpoint values this week. We'll see why in a moment. Okay, let's start off with Amazon, and oh gosh, Amazon's been trying to break out over the HB4 for some period of time now, hasn't it? Actually, I guess since early July, and it looks like it's trying again. We'll have to see if it can hold. And in doing so, it is joined by Microsoft, which has been trying to do the same thing, except at its HB2. Now, you'll remember last year when we were watching Microsoft trying to break out over its HB1, I mean, it took months and months and months. But it was worth the wait, because when it did break out, we immediately rushed up one breakpoint. So that's 28% if it can do it again, and it is trying. Facebook, oh boy, look at that. Just this week, Facebook took that big spike up almost to its bubble price, and that was its high of 2017. I will be really curious to see whether this stock can go any further. Mind you, I said this about NVIDIA, didn't I? We were watching the stock get up to its HB4, and that was its 2017 high, and had been sort of in that channel for some months, unable to break out. Well, this time it looks as if it's been able to do it. Alphabet, well, Alphabet did as I thought it would do. It broke out its setback, and then it has been moving up once again. Again, I don't know whether it can reach its MSG price. It hasn't been able to in 10 years, so I guess we'll have to wait and see. Netflix, the most aggravating stock in the whole market, or at least in the FANGs anyway. Okay, it wouldn't break out, wouldn't break out, then it did break out, and then it promptly failed. And now, well, it's trying to do it again, maybe trying to join the rest of its buddies in having a little run. Whether before the end of the market or not remains to be seen. And finally, Apple, our feature stock. What's Apple doing? Well, you know, I suspect that Apple is actually breaking out, because if we extend the slope of that line just before the little curl there, you'll see that if that line had kept on going, then the stock would have broken out. And of course, the reason for that slope on the line was because of the stock buybacks. So it's going to be interesting to see when we get an updated balance sheet, which unfortunately, of course, won't be for some while because we just got one. But it'll be interesting to see if it has indeed broken out. So all in all, Amazon remains on the fence, or just above HB3, and may or may not be committed to going any higher. Microsoft continues to dither at its HB2, although it looks more promising. And again, remember how long it took to break out last year. Hey, we've watched that for a long time. Netflix, not to be left behind, has made a sudden dash for glory this week. Well, let's see if that's for real. Facebook remains in an uptrend, but it's almost reached our upside target, its old high. But 2 weeks ago, NVIDIA was closing in on its extreme high, and I said I wouldn't count on it going any higher and never be in a rush to prejudge anything in the stock market. This week, it seems to be trying to do just that. Alphabet set back and tested its breakout and has bounced nicely, as I observed would happen. I suspect, by the way, remember our viewer who had lost $9,000 by buying too early? Well, I suspect that she is back on the positive side again. But again, past evidence does not suggest that it can actually reach up to its MSG price or 5.5 times book. But as they say or sang on Sesame Street, one of these stocks is not like the others. One of these stocks doesn't belong. And that's Apple, as we will see, which is today's featured stock. And the stock may be breaking out as well. To remind our viewers, last week, I noted that the total market cap of Apple was crossing the $2 trillion mark, and I questioned whether the shares could go much higher. There's a lot of controversy about how expensive the shares are. But I said that I would lay out for you a roadmap of how Apple could double its market cap to $4 trillion. And indeed, it looks like it's planning to do just that. This is not some nutty hypothesis based on some imagined future potential growth as conceived by me, or any other analyst for that matter. It's based on a purely mechanical and deliberate approach to price enhancement, which is already in use by Apple, as well as close to 100 companies in the S&P 500 and the TSX, plus, I'm sure, many more. Note that I said price enhancement, not value enhancement. Essentially, I'm going to show you how to create an exciting growth stock when one doesn't exist. Now, why did I say that? Well, the sales and earnings growth over the past 5 years have really barely budged. And the growth of sales forecast for next year is only about 5% higher than the sales this year. Not 25, not 30, not even 15. But in any case, this is a story about how share buybacks enhance price but destroy value. And I'm going to illustrate it now with the SVA chart of one company, although it's one company of many. Here is Home Depot. And of course, remember that the trend of these lines is the trend growth of the balance sheet of the equity on the company. Well, growth in the equity in the company, it's gone right into the ditch. Well, if that's the case, how in the name of goodness has the price to book of the company gone up and up and up and up? Well, that's very simple. The more that the company buys back stock and the fewer dollars of equity outstanding, the higher is the ROE. And this dotted line here shows the trend of the ROE of Home Depot. Now it is rolling over here a little bit, but nonetheless you can see that trend. And what I find in stock after stock, time after time, is that when the ROE is going up, so is the valuation in price to book terms. With buybacks, on the plus side, in the short term, there are fewer shares outstanding over which to spread future earnings, and all things being equal, the earnings per share should go up. But more to the point, with less equity in the company, the ROE, the return on equity, rises as well. And the ROE can essentially approach infinity as all of the equity disappears. These kinds of companies we call the adtractors. The price goes up, we add in response to the rising ROE, but the safety of the equity cushion vanishes. It subtracts, or that's our adtractors. Apple appears to be in the early stages of emulating Home Depot. The book value of its equity has already dropped in half since 2017, from 142 billion to 74 billion. But with the addition of that $5 billion of debt, which they've just raised, it looks as if they are accelerating the process of destroying their equity base and coming close to an infinite ROE. 4 trillion in market cap. Here we come. Now, I've left out one key issue, haven't I? I've showed you how price can be enhanced to almost unbelievable heights, and a $4 trillion market cap for Apple would not be beyond attainment. But if you, the company management, create that sort of price, and there is no underlying value, how are you planning to bring the shares back down to some kind of sustainable level again? And let me tell you, Home Depot is not alone. There are close to 100 companies in the S&P and TSX that look like this. You may well own one of them yourself. I believe that these managements are not planning to do that. And the evidence is that the insiders are selling their shares to the public and the so-called professional investors. You are on your own hook when it comes to getting out. And the average price decline that we observe just to get back to their intrinsic fair market value valuations exceeds 50 to 75% in many cases. Many of these companies have slow or no organic growth at all, and they all have excessive PE ratios. Too many of these companies are large cap stocks which dominate the indices, which means that they are excessively popular, albeit with decent price momentum, as we've already shown. And therefore, holders of the major ETFs will get slaughtered on the way down. These managements are not the old-fashioned Ben Graham style of operators, so ably represented by Henry Singleton of Teledyne, who see part of their function as adding value in the good times in order to diminish the price risks in the poor times. Here's a 20-year view of Henry Singleton's Teledyne, and look at that, the beautiful, beautiful growth of the book value. So if you are dead wrong and you buy at the extreme top of one of those moves, well, okay. It's just a matter of time till you get back on side again. But let's go back and take a look at Home Depot. If this stock collapses, how long do you suppose it will take before you'll ever get back on side here? You may wish to avoid the losses that these stocks will entail, and our SVA charts will show you clearly which companies to avoid, and more to the point, why they should be avoided. In this context, and this late in the market cycle, the SVA service, I think, can be thought of as portfolio insurance policy, which is entirely tax deductible. You can probably measure its worth to you by calculating how large a loss you would take if only one of your 3 largest positions declined by 25% or worse, and you could have avoided that loss. Odds are that our service cost is a modest fraction of that amount. Anyway, if what you have seen interests you today, and you'd like to see what your own stocks are telling you, and you want to take the next step in your investing journey, as so many have now in the past few months, then send us an email at info@strategicanalysis.ca. Clients get lots of benefits, not just access to over 3,000 charts of North American stocks, but commentary, trade ideas, weekly webinars where we go into the nitty-gritty of how to use the charts in order to become a better investor. When you sign up, I will personally take you through our system on a one-on-one video conference and show you how you can use our service to become a more confident and profitable investor. If this sounds like something you think is in line with your goals, then let's take this next step together. For now, this has been Ross Healy, the chairman of Strategic Analysis Corporation and the senior portfolio manager at McNichol & Associates Asset Management, reminding you that nothing, including investing, is difficult if you have the right tools. I'll see you next week.